The first analogy, it is such concept wherever the money is involved in the business, when money is introduced in the business to commence a business, that is called as capital. It is an amount which is getting invested in a business to carry out the business activities. Then liabilities, whatever are going to be the obligations for the business to pay out, those are all going to be the liabilities. Example given is bank loan, which we are supposed to pay. Then the supplier's payment, which we are supposed to pay. I mean, we are going to get certain raw material on credit. So we have to pay to the person from whom we have purchased goods. So logically, that becomes our liability to pay such person. Then if we have obtained any loan from or any kind of borrowings from our friends, family, any kind of acquaintances, any, so in that case, that those all become our liability. Assets of the business which the business owns. So that means suppose a business is owning land, any particular premise or building, or any vehicle, computer, furniture, machinery, then these are all becoming the assets. Even for certain businesses, livestock also become the asset. Livestock as in all the cattle and the animals, the poultry, the animals, like a poultry business will have certain animals as their main asset. For the dairy business, the cow and buffalo become the main asset for them. For any kind of business which are dependent on animal husbandry or any product for which the raw material comes from animals, those all become the raw material, and in that case those all become the assets of the businesses. Assets are tangible or intangible. Let me give the example. Tangible, that means which we can see, feel, touch, like machinery which we can see, feel, touch, car, computer, furniture, land, building, premises, those all things which we can see, we can feel, we can touch, we can check, we can certain goods which we can move also, like car, vehicle, like or this is any machinery or computer which we can even move. These are also movable. Certain kind of goods, certain kind of assets which are intangible in nature. I mean, those are existing in the business, but we can't see that. Example, the first is the goodwill. Goodwill, that means over a period of time, a business is getting certain good recognition in the market and is getting popular, is getting reputed in the market. Because of the reputation earned by the business, it is going to get certain goodwill, a good standing in the market. A very ethical business will be having good reputation in the market, and that reputation has certain value. That value is called as goodwill. I hope the concept is clear to you. I'll repeat. Goodwill is something which over a period of time a business is going to earn. So whenever a business is going very ethically, morally, integrally correct, then these businesses are going to earn certain goodwill over a period of time. And if at all the business is entered or indulged into any kind of frauds, any kind of investigations are happening, involved in any scams and scandals, then in that case the goodwill amount is going to get reduced. So this is something which we count, which we cannot see, feel, touch, goodwill, but we can quantify them. We can quantify, we can monetize them. So that is also an asset. Example other than that is geographical indication, then the trademark, service mark, patents, copyrights. Those all things are called as the assets. I'll repeat. Goodwill is an intangible asset, and all the intellectual property rights like the trademark, service mark, then patents, copyrights, and geographical indications all are considered to be the intangible assets. Now, example of geographical indication. Nearby example is, let's take, Darjeeling tea is very famous. So Darjeeling and Assam has got geographical indication over tea product. So the tea from Assam is very famous. So Assam has got geographical indication. Strawberries from Mahabaleshwar in Maharashtra has got the geographical indication. Kerala has got the geographical indication over rubber and coffee. Then the Konkan region in Maharashtra, again Ratnagiri and Devgad especially have got geographical indication for Alfonso mangoes. Then Kashmir is known for apples. Kashmir is known for Pashmina shawls. So these have got these areas, geographical areas, have got certain importance due to its commercial value of certain products. Those are called as geographical indications. Worldwide, if you consider, then the Scotch liquor kind of thing. Scotch is available from Scotland. Perfumes are from Paris, so they have got geographical indications. Champagne is from the one village in France named as Champagne. So these have got the geographical indications. These are all considered as the intangible asset. Next is revenue. Whenever money is going to received by selling the product, it's going to be the revenue. Revenue, that means by any way we are going to receive certain monetary benefit, that is called as revenue, especially by way of selling the actual goods of the company. Then revenue is the revenue something which we earn. So expenses are exactly opposite, which we are going to spend. So the spendings will be called as the expenditures. When revenue and expenditure will be having a certain gap, we have to consider this gap with either profit or loss. So if revenues are more and expenses are less, we come to profit. When expenses are more and revenue is less, we come to a loss. And simple and logically, we can connect to the same. The next slide is debtors. Debtors are always going to be into picture when there is a sale from the company and that sale is on the credit basis. So two conditions to be considered for the concept of debtors. The first one is there has to be a sale, and second condition, the sale has to be on the credit basis. That means there is no cash transaction involvement in the sale process. So that time these creditors will the debtors will come to know. Then the creditors, that means again two concepts: the person from whom we have purchased goods, and second one is those purchases are on credit basis. So debtor, sale and credit, creditors, purchase and on credit. Understand the difference very well. Get these concepts to your value addition, knowledge addition, and remember those. Drawings, again, it's nowhere a drawing as in a picture or a painting or sculpture. Nowhere it is has got resemblance. When we are going to enter these certain monies into the business, when we are pouring certain money in the business, we call it as capital. Because we are going to give this money to the business, we name it as capital. But when we are going to withdraw certain money from the business for personal use, we are going to call it as drawing. Now, I have my business. I have put in, suppose, 10 lakhs of money as a capital. Now, I'm running the business very well. For my business purpose, okay, remember, carefully listen. For my business purpose, I would need to travel abroad. Okay, so I'm taking certain monies from the business and I'm going on a business tour to, suppose, Indonesia. Now, Indonesia and Singapore, Malaysia, I am going to not travel those 2-3 countries, Southeast Asian countries, and there I'm going to acquire certain business there, at least business customers. So I am on a business tour. So in that case, those expenditures will be there relating to the business, and not for my personal use. I'm going to go for a business tour. So those are still the business expenditures. Now, I have earned enough profits out of these businesses, etc. I got good connections, good business customers from the Southeast Asian countries. Now, the next year, I plan to go with my family to enjoy vacations at Bali, again, Indonesia. Okay. So I'm going to Bali to enjoy with my family, and I'm going to withdraw a certain amount from my business. I am going to enjoy with my family. I am withdrawing, suppose 5 lakh rupees from the business for this entire my uh, personal holidays. In this case, this 5 lakh rupees is considered as the drawings, simply because I have utilized this for the personal use and not for business purposes. I hope the concept of drawing is very clear to you. Accrual concept. Accrual are the one which we are supposed to receive but not receive. Like I have credit sale. I'm going to receive certain monies from other person. So in the next maybe 2-3 months, I'm going to receive the amount. But today at this moment, I'm going to mark the transaction of sale in my books of accounts that I have sold goods today and I'm going to receive income after 3 months. So that 3 months of span in which I have not received the income, yet I mark the sale, that is something called as the accrued income. Accrued, that means which is yet to arrive, but I'm still recording in a business. Again, example is I am supposed to pay bonus to the employees. In the month of November, I'm supposed to pay bonus to the employees, and for which I'm going to make provision right now. So those are going to be my accrued expenditures. That means I'm going to make the payment in the month of November, but yet I'm marking entry as of today. Are all considered to be the accruals. I'll move on now to purchases. Those goods which are acquired by the business for producing an output for sale. That means a raw material purchased, done with the certain processes in the manufacturing unit, and going for the labeling and packaging, and going then for a sale. So from raw material purchases to the finished product, this entire process will be called as the production process. But for the production process, we need to have certain purchases of raw material. Now, raw material of one company can be the finished product of another company. I'll repeat. Raw material of one company could be the finished product of another company. Example given is, there is a car manufacturing company, say Tata Motors. Now, Tata Motors is going to take lot many of the raw material from different vendors. So from so many of these raw material suppliers, they are going to take a lot many of the hundreds of the products. Those all products are getting assimilated. Those all products are getting assembled properly, and then the car is. The rest of all this painting and this designing, etc., will be done by Tata Motors. But those small parts which are utilized for car manufacturing are all going to be a raw material for Tata Motors. But the same raw material is being supplied by some suppliers. For those suppliers, this is going to be the finished product. So for them, these particular part of the car going to be the finished product which they are selling to Tata Motors, and for Tata Motors, it becomes a raw material. So here purchases from and to will all be under the head purchases. Depreciation. The depreciation is charged on the fixed asset because of the wear and tear purpose. The exception is only of land, which is the value of which is going to get appreciated over a period of time. But other assets like the building premises, building premises, car, vehicle, any furniture, computer, machinery, these are all going to depreciate over a period of time. Again, the reason being because its utility, its productivity gets reduced over a period of time due to excessive utilization. and that's why the value gets deteriorate over a period of time. The quality, the quantity of output gets reduced over a period of time. For that purpose, we need to charge depreciation. After a certain period of time, the machinery value, example, machinery is purchased for 1 crore rupees and it will be utilized for 10 years. So the output which it was providing at the first year, the same output may not receive at the 8th or 9th year. Reason being, it has been utilized continuously for 9 years together. It is supposed to give certain repairs, asking for repairs and maintenance, giving certain we can say breakdowns in that case, and that's why the depreciation amount is to be considered. Next is stock. Stock, that means the property which is held for the sale in the ordinary business or in the process of production of such sale or both. Now, we are going to keep the stock ready. That's going to be a raw material stock, so that whenever there is a demand, we can procure the need by putting more and more products under the production process. So you are maintaining the stock of raw material because those production processes are still ongoing. Then once you are ready with the finished product, till the time those all products are getting sold, you are going to make a stock of it. So stock can be during the purchase, that is before the purchase, before the production process, or it can be after the production process. So it can be at the time of purchases, or the stock can be at the time of sale. Stock can be of raw material, stock can be of the finished product. So here, both the stock will be called as opening stock and closing stock here. That means those stocks which are appearing on the first day of the accounting period will be called as opening stock, and those stock which are available at the end of the year will be called as closing stock. Next is stock is always also considered as the inventory. Certain cases you will find the word inventory. Certain times you will find the word stock. You can consider those as the synonyms for the accounting knowledge. The next is the bad debts concept. Bad debts are always supposed to be matched with debtors. So whenever there are debtors, that means the customers who are supposed to pay to us, we understand and we consider that there can be certain defaults by the customers. Certain customers will not pay on time, certain customers will never pay, or certain customers will be paying delayed payments, half payment, and not the making full payments also. They may be asking for discounts. So certain cases where the money is not recoverable, that money, such customers who are not going to pay to us as a businessman, then in that case we mark them as the bad debts. So debt which is not recovered from the debtors considered as bad debts. So this bad debt concept should always be linked with debtors. I hope these concepts are clear. Now I'll move on to the next slide, which we have not seen in the last session. Effects of financial transaction on accounting equation. This is really difficult to understand for the non-commerce students or even for the commerce students. Assets, liabilities, income, and expenditures. These are the 4 areas which we need to consider. Assets, example I'll give you better. So capital account is considered to be personal account. Then drawings. So one person is investing money in the business, will be his capital. So a person is going to invest, so it's a personal account. So a person is going to withdraw from the business, so it's all drawing is also going to be a personal account. Then bank account is going to be personal account. So any kind of bank in which we are going to deposit our monies, so this is going to be a personal account. Then any other company, XYZ Limited, say for example, it's going to be XYZ Limited or any sole proprietorship concern. So those are all going to be the personal accounts. I'll move on to real account. There are not so many examples of personal accounts. All the creditors account would be personal accounts. All the debtors are going to be the personal account. Like I'm going to sell to a certain person or I'm going to sell goods to a certain company. So if that's a company or if that is a main person, they are all the personal accounts. Real accounts are the one in which I am supposed to consider the cash first. Cash account, that's what you can see, feel, touch. All the assets are considered in this particular area. So I'll consider machinery account, then land, say next building, goodwill account, no, all kind of things you can consider. You can add on vehicle, livestock, equipments, loose tools, furniture, computer. These are all things which you can consider. These are all the real accounts, which we are going to spend certain amounts towards purchasing those assets. Those are all considered to be the real accounts. So these are all the assets. And nominal account are all such expenditures or incomes which you are going to receive. Like example, you can say salary account. It's going to be your expenditure, so it's a nominal account. Then the electricity bill, for example, electricity bill, which is required for the businesses, printing and stationery, audit fees. Then suppose the traveling expenses, advertisement, general expense, management expenses, all these. Then suppose discount received. If we have received discount, if we have received interest. So nominal account is going to be all the expenses and incomes. Those we are going to consider under nominal account. I hope that's clear to you. So these are certain examples. Now, these personal accounts are mainly considered to be into the assets, or they can be of a liability nature. How goodwill is real account? We are not able to see this. I hope so. Goodwill account becomes a real account because it's an asset and it's an intangible account. So real account is, though you cannot see it really, but a real word and really you can see it or not does not have any resemblance. Real account considers to be all assets and goodwill becomes the intangible asset, and that's why it is into the real account. The one value which we consider. Okay. Move on to the next. There are certain assets and transactions which we consider. When there is an increase in one asset, the other asset is going to decrease. So let's take example. There is one asset. So for this example, so for the first example, the one which is I marked bold. So there is one asset which is increasing and another asset which is decreasing. Like I have certain cash in my business, so cash is my asset. Now, with the help of this cash, I'm going to purchase one more asset. Say, for example, machinery I purchased. Okay. So, if I purchase machinery, that means I'm going to add machinery. So, there is going to be an increase in the machinery. At the same time, I'm going to reduce my cash balance because I have to pay for the machinery. So, my other asset, that is cash, is going to get reduced. So, purchase machinery for cash is a transaction where My one asset is getting increased, that means machinery. Another getting decreased, that means the cash. Here, increase in one liability, increase in one liability, decrease in another liability. Likewise, there are several examples which I can give, cycle which we are going to follow throughout the session. The first is identifying and analyzing transactions. What we have to identify from the transaction is which accounts are there: cash, salary, bank, cash, personal account, and then real account or nominal account, personal account or nominal account. These all transactions we are supposed to identify and analyze. Once we analyze these transactions, the second we are going to pass the journal entry for the same. After the journal entry, we are going to post to the ledger accounts. After posting these ledgers, we are going to prepare the unadjusted trial balance. We are supposed to make the adjusting entries, and then we go with the preparation of the trial balance. Then we prepare the financial statements. So financial statements as in the profit and loss account, balance sheet, cash flow statement, fund flow statement, etc. And the last transaction is make closing entries. That means we have to close the accounting year and we have to come up with certain reports on the same. That means we are supposed to prepare the board of directors report, audit report, and we have to declare the profitability, dividend, and all those areas when we are finishing with these financial statements. Journal. Now, what exactly is journal? It's the very first entry in the books of accounts after the bookkeeping is done. So bookkeeping, that means we are going to maintain certain books of accounts, and those books are utilized as per the transactions. So suppose cash deposited in the bank, that means we should be paying amount to the bank. So our two accounts will be reflected. The one is cash book, in which we'll enter that cash is been out of the business. The second one is our bank passbook, which will have our entry that the amount is being received by the bank. So two books will be there. Suppose there is going to be a sale, okay, sale of any goods on cash. So we'll be having again two entries. One is cash we are going to receive, and another one is sale which we have made. So there is going to be a sales book and there is going to be a cash book. Cash entered, sale happened. So sale, that means sale in the book which we are going to consider goods have been out of the business. If we are going to purchase goods on cash, then there are going to be two books. One is cash book and another one is purchase book. So purchases in which we consider goods have entered the business, and cash which is been out of the business. So purchase is an expenditure for us and cash has been out of the business. So we are going to maintain cash book in which we are minusing the cash book. Why? Because cash goes out of the business. Purchases in the way we are going to make addition because goods are added on to the existing stock. I hope the concepts are getting clear. I am not getting very fast. Of journal. Now this is the format, okay? These 5 columns is the format. First column starts with date. It's going to be a date on which a transaction is happened and entered in the books. So date can be any kind of date during the accounting year. The accounting year starts from 1st of April, ends on 31st of March. So the transactions happening in between this period will be recorded properly in the sequence wise, date wise. So that's why date is very, very relevant. So date is to be mentioned in the DD, MM and the YYY format. So date, month and year format. Then particulars. Particulars, that means whatever is happening. So cash entered the business. So cash and capital, those two transactions will be considered. So we are going to consider cash entered the business. That means debit what comes in. Cash come in the business. Capital is the person has given the capital. So credit the giver. Capital is credited. So cash account debit to capital. The system of writing it is cash account will always, the debit account should always write first. Below that, leave some space indented and then mention as the credit figure. So the to capital account and then the whatever the amount is. Ledger folio is the third column, which is the smallest column in the journal. The ledger folio we need to mention just simply to relate the same and give a reference to the ledger folios. Wherever the journal entries are passed, whatever the number comes, we are going to mark it as 1, 2, 3, 4, 5. Again, there is going to be 1, so 1 is mentioned. Say, for example, the first is cash entered the business, cash introduced in the business by way of capital, so rupees 50,000. So my first transaction is cash account debit to capital 50,000. For cash, I'm going to give ledger folio 1. For capital, I'm going to mark it as 2. Next transaction is goods purchased for cash rupees 5,000. Now in this case, I have purchases the goods, thus I will be getting goods and cash will be out of the business. So the rule of purchase account is nominal account, then debit all expenditures and losses, credit all income and gains. Purchases, by way of purchases, I'm making expenditure. So purchases account debit to cash is going to be my second entry. Okay. Okay, the first transaction is cash introduced in business rupees 50,000. The second transaction is goods purchased for cash rupees 5,000. The third is pay commission rupees 200. Fourth transaction is sold goods for cash rupees 15,000. Okay, we'll see only these 4 transactions as of now. Here I'm supposed to mark first as date, okay, for cash. Assume this 1, 2, 3, 4 as the 1st January, or say small example, 1st July 23. This is going to be the 2nd July 23. This transaction is of 3rd July 23. And this transaction is of 4th July 23. I hope this is going to be clear with you now. Here it's going to be particulars. Then I'm going to mark it as LF, ledger folio. Here it's going to be amount, in which I'm going to write the debit amount, and the next amount is the credit. There I'm going to write the credit amount. As I mentioned, I need not to make the ledger folio column big enough. The smaller, the better. Okay, let me mark the first transaction. It's going to be of 1st July. So let me mark this first 7 to is 1st July 2023. Then the first transaction is cash introduced in business rupees 50,000. So here cash entered the business. So it's going to be the cash account, debit to capital account. And here I am supposed to give the narration. Narration, that means I am supposed to narrate why this transaction has happened. So being cash introduced in business. That's going to be my narration. I'm going to narrate a story as to why this transaction considered. Then for cash, I'm going to give 1 number folio. For capital, it's 2 number folio. Debit amount should be mentioned over here. So it's 50,000 I'm going to mention here. And the credit amount should be mentioned at the credit column, rupees 50,000. I hope that's clear to you. Now moving on to the next transaction. It's 2nd July 2023. Again, sorry. Here, goods purchased for cash. Now, I have purchased goods and the cash is out of the business. So I'm going to write here as purchases account debit to cash account. Being goods purchased for cash. That's going to be my narration here. Ledger folio. Now look here. I don't, it's 1 number, 2 number, and for purchases has got for the first time. I'm going to mark it as 3. But cash has appeared second time. The first folio I'm going to repeat here as 3-1. Reason being cash was provided 1 number as the ledger folio reference. So it's going to be like this. 5,000 I'm going to mention here, and here 5,000. Moving on to the next transaction of 3rd July. Pay commission rupees 200. So here commission I'm going to pay. So here pay, that means I'm going to make payment. Cash is going to be out of the business and I'm going to pay commission. So there are 2 accounts, commission and cash would be entered. So commission is my expenditure. So nominal account rule will be applicable. Debit all expenditures and losses. Credit all income and gains. So here commission is my expenditure. I should give debit to the commission account. Commission account is on the debit side to cash account, and the narration is being commission paid. Then the amount, now look here, purchases is on 3rd. Now there is no folio given for per commission, so I'll mark it as 4 number. But for cash again, there is already a folio given to the cash, that is 1. So I'll mark it here as 1. Commission is of 200 rupees. I'll write here as 200. The next and last transaction is of 4th July 2023. Sold goods for cash rupees 15,000. Now here goods are sold and I have received cash in the business. Thus, cash is a real account, debit what comes in, cash account is debit because I have received cash. Debit what comes in, cash received. To sales account, Now, why sales account is credited? Because sales is our income. By way of sale, we are going to receive certain income. Nominal account rule here, debit all expenditures and losses, credit all income and gains, and thus credit will be given to sales account. So cash here is marked 1. We do not have sales account before, so we will be marking it as new number as 5. Cash 15,000 and sales amount 15,000. Okay, so I'll repeat this slide again. I'll explain this again. The first transaction is cash introduced in business. Get this clear. In this transaction, we have got cash and capital as considered. Cash is a real account, capital is a personal account. So here, cash is a real account, so real account rule to be applicable. For capital, personal account rule is to be applicable. Now, cash account rule debit, this debit all, debit what comes in, credit what goes out. That's the rule of real account which you have to apply. So look at the transaction, cash introduced in the business. So from the business point of view, you have received the cash. That means cash has entered the business. So that means debit what comes in, you have to apply the debit account rule here, and thus cash account is debited. Capital, some person has given, the capital is personal account, and someone has given the capital. So credit the giver, debit the receiver, credit the giver. Some person has given the capital, so capital will always be credited. The folio number, cash comes as number 1, so here I'll write as number 1, capital as number 2. There is no such requirement that you are supposed to always mark cash as number 1. If, for example, your purchase account to cash account, this entry comes as your first entry, then in this case, purchase account will be marked as 1 and cash account will be marked as 2. Whatever the entry starts from the first, you are supposed to accordingly start with the numbering of this ledger folios. So cash account is marked 1, capital account marked 2. Amount is, as it is mentioned, 50,000 here. Now in this second transaction, goods purchased for cash, 2 transactions are there. Cash has been out of the business and we purchase the goods. So again, look for the transaction. Cash is a real account and purchases is a nominal account. It's an expense or income. So a purchase is going to be the nominal account. Apply the rule of real account for cash. Debit what comes in, credit what goes out. Now in this case, goods have purchased for cash. That means we have paid the cash, and that's why cash is being out of the business. Cash would be credited. So I have credited the cash. And purchases is going to be there. So purchase account is going to debit because the purchases are made. That means we have made an expenditure. So it's going to be on the debit side. Now, 1 and 2, there is purchase account new one. So we are marking it as 3. The cash account has already been marked with number 1. So I'm repeating the same number here as 1. Next is pay commission, in which we are again going to have 2 transactions. One is cash we have paid, and for commission we have paid the cash. So by way of commission we have paid the cash. So commission is going to be our expenditure. Here nominal account rule will be applicable for commission. Debit all expenditures and losses, credit all income and gains. So commission is our expenditure, marking it as debit. Cash account we pay, that means cash goes out of the business. Credit what goes out, cash go out of the business. After this 1, 2 and 3, commission is a new account, so I'm marking it as 4. But cash is again repeated from the first, so we are going to mark it as again 1 number reference. Moving on to the next and last transaction for today. Goods sold for cash. Here again, cash and sales are the 2 transactions considered. Cash again is a real account. Sales is going to be a nominal account because we are going to receive income by way of sales. So apply the real account rule for cash, debit what comes in, credit what goes out. So here, when we sold goods, we receive cash. And that's why cash has entered the business. Debit what comes in, cash is debited. To sales account, that means sales is going to be our income. So credit all income and gains, apply the nominal account rule there. And that's why it's going to be sales account credit. Again, check the numbers. Up to commission, it was 4 number. For cash, again, the same number will repeat as 1. Sales account is new account, so we are going to hit the new number 5. I hope that the elaboration, the explanation is pretty clear to you now.